Today, the main theme will be talking about tightening policy at the wrong time. Apologies for, slow uploads, really just taking a new course, professional course recently. It sounds like an excuse, definitely is. But yeah, no, appreciate anyone still watching. And the what I'm trying to figure out or talk about is for tightening policy at the wrong time is the Fed is trying to or talk about more tapering because of inflation concerns, but I expect from economic data that US economy has already peaked and is coming down, and that means any tightening policy will be disastrous. And if that actually is true, then I expect the Fed to turn around, go from hawkish back to dovish, meaning more QE, more money printing, not so concerned about inflation because we got to keep asset prices high. Again, I'm not saying that's the right thing to do, I'm just saying what I expect them to do. And if that is the case, then what will happen to, various asset prices? Let's talk about the executive summary. First off, congratulations to Chairman Powell. Finally got his renomination. It's kind of funny, immediately after his renomination, there's kind of a switch in tone from dovish to hawkish. So now that he doesn't have to worry about his renomination, he can go back to himself being more on the hawkish side, just right off the centerpiece. And also, his runner-up is getting the nomination for vice chair. She's a lot more hawkish. And so, now that he doesn't have to worry about his renomination, he doesn't have to stay dovish in order to continue pumping up the economy. And he can, focus on talking about inflation. Next up, economic data. So we'll take a look at PMI, employment data, and CPI. Equities market, we've seen a broad sell-off since the new COVID variant news. Honestly, my opinion is just that, most stocks are just overvalued. It's not so much on, new COVID variant news, but, we can talk about it later. Treasury yields and US dollar index. So we've seen the 2-10 spread actually shrinking. The midterm is rising while long-term continues to come down. We'll talk about why and potentially why. DXY hit the target of 96.5, and we're kind of seeing what the next move will be. And finally, we'll wrap up with some commodities update. So first off, Powell's renomination. So again, funny thing, right after his renomination, the next time he spoke was there's been a switch in tone. He's mentioning that tapering might have to begin sooner or even more aggressive due to inflation. We've seen the whole tone swift, there's no inflation. Oh, there is inflation, but it's not high. Oh, there's high inflation, but it's only transitory, to now like, oh, inflation will persist, but only due to supply chain. So it'll be high, it'll persist for some time, but it won't continue. And now it's like, okay, we have to do something about it. It's kind of funny. So let's look at the two mandates again. The stable prices, it's kind of defined now to be, 2% year over year on average too. You gotta, average it out, make up for years that you didn't have 2% inflation. Again, kind of funny. Full employment. And it looks like they're agreeing that the full employment picture has been achieved. It's kind of weird while the labor participation rates are not increasing. So what is happening is like, because the classification of unemployed is someone who's looking for a job but is not employed, while you don't account for people who gave up looking for work, or so they're not in the labor force, so therefore, um, they're not counted in the unemployment data. So the hypothesis here is that economy has peaked, and that means any tightening policy here will be disastrous. And the reason for that is because of political reasons that the Fed has been acting along with the economy. So economy is going up, they keep loosening policy. Instead of tightening when they should have, when economy is about to peak or is peaking. Now that if the economy has peaked and it's already coming downturn and you enact tightening policy, that will be disastrous. And, again, they missed the opportunity to do the right thing because of political reasons, for both, election wise and for Powell's predomination. And let's see if this hypothesis will be proven true. Talking about economic data, so we see the PMI have turned down from its high of 62, I think, to now 58 and 56 for the past 2 months. And I expect it to go negative, meaning like below 50 in the future. Like not, it's because, you go, are you confident or not confident, neutral or confident, so, and then you average it out. And so anything below 50 means that the producers are not optimistic. And taking taking a deep dive into the actual data is kind of interesting for the past month, because the past 2 months, I think, again, is 58 and 56. So you're like, oh, there's not much change. But if you actually take into the details, we're seeing less participants are more on the high side to more into just neutral. So so total doesn't look too much different, but the details itself is telling you that more participants are kind of neutral instead of being on both ends. So economic data, we see that unemployment rate is probably at or near peak or past it. But the problem is labor participation and productivity is not rising. And so that's why we're seeing continuously a lot of labor shortages in the market, especially on the more low skilled level. A lot of the reasoning being that the younger generations, a lot of them are not willing to, work now. A lot of people are just staying home playing with crypto or NFT, whatever. So a lot of gambling going on, and because the outlook for a lot of these careers are not very enticing, so therefore they're just not interested. And finally, let's cover out with CPI. So it continues higher, and I expect it to stay at current levels, like not go way high, like 10, 20%. I think we'll stay around this 5 to 7% mark, with different components supporting it. So meaning like some components will come down, but the others will come back, will go up to support that level. And what I expect going forward is real estate via the owner's equivalent rent, like it's kind of a fake thing, but I still expect that to be one of the items to support it, and Medicare going forward being the next items to keep CPI at these levels. Now let's take a look at the equities market. So the news to the COVID variant Omicron, kind of funny, where WHO announced it at midnight of local time. Like at their local time, it was midnight. So like honestly, who's working that Twitter account? I think they could have broken the news earlier, but they chose that time because it was right before the opening in Asia market on Monday. So what happens is, again, any bad news, just like the Lehman Brothers thing, just don't do it on a regular day. Just do it over the weekend on Sunday, right before the Asian market opens. So let Asia market deal with it, digest it, and then European market digest it, and then then the US market take over. So it won't be too big of a news. So let all of them get wrecked first, and then the overreact should kind of be over. And then recently, we're actually seeing a lot of tech stocks insiders selling, like Google founder and CEO Elon for Tesla. And these are things that you need to watch. I think Microsoft as well, for CEO, but these are things that you have to watch for. If the insiders are selling, maybe something's up. And if you're a holder of these companies, you don't want insiders to sell. Um, maybe these are their scheduled selling for spending purposes, or maybe they know something else that you don't. Future outlook, I still think these, like for US, these indices are overvalued just because, I don't think things are as rosy as they try to depict it as. But short-term wise, I do expect some bounce given the quick drawdown and they're close to their neckline and some has broken. But I think, that you should, like, honestly, if it keeps going down, great. I don't have any issues with it. But I do expect it to bounce a bit. But in terms of long-term picture wise, until the Fed switches narrative, um, I don't think long-term will be bearish. Like I'm not optimistic about these indices even at these levels until there's a switch in narrative on the Fed's part regarding their monetary policy, and we'll talk about it later. So taking a look at Treasury yields and US dollar index, um, so the spread again, the spread between the twos and tens are shrinking, and the what that means is the midterm bond yield is rising while the long term is falling. Now, what do these kind of mean? So short term, like meaning less than 1 year, is more for liquidity reasons. And that could be a concern with the tapering. Midterm, which 2 to 5 years, these are more for like business decisions, like, okay, am I going to buy this equipment? Okay, um, is the lending rate right now worth it for me to do so? So a lot of business decision is kind of more on the midterm. And then finally, long term is more long-term economic perspective. So these are your 10, 20, and 30-year bonds. And with this kind of image showing, the, with the yield curve flattening on where the midterm's rising, the long term's coming down, to me, that means the bond traders or whoever, the bond investors are more concerned about inflation being persistent. So they're trying to price that into their business decision as well, while they're not optimistic about long-term US growth. And one of the things that, we've seen happen, like for example, like a bankrupt company or a bankrupt country, like I guess Greece, what you have is short term to, or like the really near midterm bond yield, the return is very high, higher than like a 10-year. The reason for that is because, this company does not have 10 years. They will go, bust. But, in the very short term, you can gamble with it. So like there's still like a very short term possibility of like surviving to like the next, quarter report while there's no long term. So if it does invert, shit hits a fan. I don't think that will be the case, but as it shrinks, that is definitely alarming. So talking about the DXY, again, as expected, it rose. It helped draw down commodity prices. I do expect it to continue rising with Fed tapering. But again, I expect the Fed to switch the narrative to dovish in the future. The reason for that is because, again, they're doing tightening policy at a wrong time, and that would be disastrous. And due to political reason, like where Biden wants to maintain control of probably the Senate in the mid-year election and also part of the House. In order for that, they need, good economy. And if we are tapering in the wrong time, because economy is coming down, then, that's not good for politics. And therefore, I feel that the Fed will switch its narrative back to dovish, so meaning more money printing, not concerned about inflation, in order to make sure they get votes. Or maybe if people really care a lot more about inflation, then they'll just fight it. But again, then you risk the kind of economic downturn. So again, the two balance, we'll see how it goes. But just hypothesis, um, and we'll see how it goes. So now let's take a look at commodities. As expected for oil, there were short-term risk. Still nothing on the Iran part yet, but this is more so um, due to the Omicron variant. Like a lot of people are getting really worried about, maybe negative oil again, or just, reduce demand for it. Um, Interestingly, from OPEC, they're holding their supply resumption, like there's nothing changed on their supply schedule. So kind of interesting. And it surely helps Biden's narrative. He helped using, political pressures to draw down oil prices, which helps remove some of the inflation pressures. And it's looking promising from the Thursday low of 62 for WTI, but let's see if that can hold. For precious metals, again, because of a strong dollar and tapering concerns, precious metals have not been able to catch a break. But I think, again, it really depends. This is a gamble. If the Fed turns back around, then, like, meaning, back to money printing, back to QE, none of this tapering talk, I expect gold to hit a new all-time high, past its $2,000 high that it made like last year of July. When? No idea. But if they do turn around, I do expect gold to perform. Um, but in terms of recently, like looking on Thursday low, um, I do think they do look promising in the short term. There is still like a lot of short-term risk. Like if the market comes down even more, like will gold finally be priced in as a safe haven, and will investors finally realizing, okay, the Fed is bluffing, they're not going to taper, they will turn back around, and so they start to front load that trade? Really depends. And finally, agriculture goods. So corn and wheat, still, and a bit of soybean, but the thing is, soybean has actually been the one that like performed the best out of these three for the past. So that's why like corn and wheat would be more overweight if anything. They're starting to look promising again. They were the like really the start of the whole commodities inflation trade, and it's possibly due to like the weathering issue. Again, we talked about this before with La Nina following El Nino, which means winters are more wet and colder, so which impacts planting. And yeah, so and there's been floods, like for example with Vancouver or Lower Mainland, like a lot of flooding in Canada, BC. So we'll see what it goes, the development going forward. But again, the main picture is if the Fed will the Fed switch its narrative, and if it does, what will happen to these various commodities prices? Thanks for watching.